The 10-year and 2-year yield curves have inverted, sending fears across the market that we could be due for a recession. In today's video, I'm going to tell you what exactly bonds are, what is a yield, how a yield curve is created, how it inverts, and what it means for the economy and the stock market as a whole. This is a full lesson and I can't wait to share it with you. Let's get started. Before we get into the video, I want to share with you how this was created. Once a month, we host a coaching call for all of our elite members. This coaching call addresses some of their concerns, and they get a chance to vote and tell us what they need help with or what they want to expand their knowledge on. This is a continuous learning element, and it happens live on a monthly basis for all of our elite members. To learn more about this membership, click the link in the description. Now let's jump right into this video.
We're going to cover what are bonds, yield curves, recession signals, and how to apply it to your trading and investing. Does that sound good? I hope so, because that's what we're going to be talking about. All right, let's start out with what are bonds. How many of you don't know exactly what a bond is? You've heard the jargon thrown around, but you don't quite know 100% what it is, who uses it, and how they work. All right, well, you're in the right place. Now, let's talk about what bonds are. So before we go into a bond, we need to talk about corporate finance basics. All right, and if you think about a corporation, that is a company such as Google, any other company out there, Google, Apple, Facebook, any company that you've ever followed, or even a company that you run, a company has one of two ways to raise capital. All right, what does a corporation need? The lifeblood of the corporation is capital. All right, cash flow obviously is king, but in order for them to generate return, they need capital. Do you agree? What are the two ways that they could finance or generate capital? Number one is to sell equity. What does selling equity mean? It means selling shares. What are shares? It's a piece of a pie that you get to own. You become a business owner when you buy stock. You're entitled to the appreciation of capital, you're entitled to dividends, and you're entitled to the growth and or loss it generates. Hopefully with good investment, it won't be many losses. So to purchase a share, you own it. You own a piece of the company. But what if instead you wanted to just loan the company money and you didn't really care about the growth of it? You didn't care that Apple generates iPhones and in 10 years it might be growing at a tremendous rate. All you want to do is lend some money, all right, and make some buck. All right, all you care about is monthly or annual cash flow. That's the purpose of your investment. You don't want to own anything. You just want to lend money to finance a corporation. That's what happens here with bonds. So bonds are issued by corporations to raise capital. There's a few differences between being a debt holder and equity holder. In the event of a bankruptcy, who do you think gets paid first? Who's first in line to receive any residual or remaining assets? Let's say a company says we're bankrupt. We're done. We're out of business. IRS. But in terms of investors, all right, the first are bondholders. Bondholders, because they're providing finance and they're not actually owners, are the first in line to receive any residual assets. So that's a key differentiation point. And then stockholders, because as a stockholder, you're an owner and owners get paid last. You technically are part of the ownership that made the company bankrupt. And so you should be paid last. So bond and debt obligations are paid off first and first in line. But for that reason, equities give you the ability to vote, and you should exercise your ability to vote. Even though you may have just a few shares, you should always vote because you have a say in the company. You're a partial owner of it. All right, so I mean, that's one small difference. For companies, when will they use either way to generate capital? That's a really in-depth conversation for another time. It doesn't really intertwine into markets as much, right? But the main thing I want to tell you is this: the government uses debt. It's called U.S. Treasuries. Another word for it is bonds. The government does not sell you equity shares, right? Because you probably wouldn't want to own a piece of the government. A government is a cost center. Basically, what that means is, at the end of the day, they make no income, all right? They're not growing. Their whole job is to finance and run the country. All right, so their main tool for generating capital is bonds or debt, and they're called treasuries. All right, again, you can think of equity as a piece of the pie and debt as a loan to a company. All right, so you're financing. Now, here's a pop quiz. Of the two, Which market do you guys think is bigger on a global basis, stocks or bonds? I had a Q&A, but it's not showing up, so just throw it in there. The bond market is larger by a long shot. Somebody said those exact same words. The bond market's consistently been larger and growing, and in 2018 and 19, it's grown even more as there's a lot of interest in bonds. All right, so you could see that the bond market is approximately $160 trillion as of 2015. All right, I couldn't find a chart with the updated stats. It's a lot bigger now, and the global stock market is only 60 trillion. So, you know, about 3 times to 1 the size of the stock market. Does that shock anyone? And I'll tell you this, stock markets or stock ownership tends to be financed by retail and institutional outfits. Institutional outfits that manage money do it on behalf of retail. So when we talk about hedge funds, all right, when we talk about ETFs, when we talk about portfolio manager positions, whose money do they manage? Mainly retail, all right, or everyday people. Bonds are a huge institutional market. So these are endowment funds, insurance companies, pension funds, big money plays in the bond market. All right. However, for the remainder of this presentation, we're going to focus on talking about bonds as it relates to government, so treasuries, because that's the conversation of today's topic. All right. So let's explain bonds a little bit deeper. So as an investor, okay, so now you're a person who has capital, and you want to purchase a bond. You want to provide your capital somewhere where it earns a return, right? That's the idea. Give away some capital, receive some return, and get your capital back. That's your goal as an investor. So here's how it works. As an investor, you decide to purchase a 5-year bond for $1,000 US. So bonds have denominations, that's what they're called. They're face values. There's the process of selling bonds in the primary market is very complex. It's through an auction process. There's bid to cover ratios, a whole bunch of stuff. What you need to know though is institutions go in and buy bonds, much larger denominations than 1,000. 1,000 is more of a corporate bond. Institutional government bonds are 100,000 denominations, all right? And you need to buy a lot of it in order to get allocation. So let's assume though we're buying a 5-year bond for $1,000. What are we doing? We're lending or loaning our capital to the government for 5 years, and our lending total is $1,000 US. All right, you guys follow so far? So far, so good? This bond promises to pay you an annual return of $50. In fact, let's switch bond to treasury because we're talking about government bonds. The government says we will give you $50 every single year as compensation for the fact you've given us $1,000 for 5 years, right? This is called a coupon payment. That's why we call money fund coupons. What is the annual yield rate? A yield means what does your investment produce? What's your return? Right? In this example, it's 5% because if you take the $50 you receive on an annual basis and divide it by your $1,000 US capital, you receive a grand total of a 5% return. Is this a good bond, by the way? I tell you what, institutional money would kill for this bond. Don't tell your friends on Wall Street that this bond was used as an example because they'll call me. They'll say, where? We heard about your elite call. How many? Forget 1,000. I want to give you 100 million denomination. I need to pay our clients. We need return. We need yield. When we say in this market that investors are hungry for yield, investors are looking for a return. Bonds are safer by nature, especially treasury bonds, because they are backed by the government. All right, what is the chance that the government goes completely bankrupt? Some people might say high, some people might say low, but the chance of a government going bankrupt is a lot less than an equity or a specific stock going bankrupt. So these are the safest bonds that you could get, treasuries. All right, so if the yield rate is 5%, and to calculate your yield rate, you just take your coupon payment and divide it by the bond price. Let's keep it simple for now. In 5 years' time, at maturity, that's what they call, when the bond comes due, it's called maturity. You receive your $1,000. Your initial investment is returned to you. All right, so in 5 years' time, you receive your $1,000 back, and what did you earn? You say, well, I just get my $1,000 back. That's not really an earned amount of investment, but $50 over 5 years is a $250 return on $1,000 of capital. That's pretty good. It's pretty darn good. It's a 25% return rate over 5 years. All right. And you might say, hey, you know what? Day trading, we could do that much quicker. But imagine this being $100 million. And the big buyers of these bonds, especially treasuries, are massive countries, institutional funds, and really big pensions. Because what does a pension do? A pension has an actuary, which is someone who just knows math really well, that does the math and says, hey, to pay out all of our pension benefits to all the retirees who are claiming pension for our company, we need to have a 4% return over the next 10 years. And what will they do? They'll say, hey, let's find a coupon rate that's at least 4% or better, and we're meeting our obligations as a pension fund. The problem is the pension funds models are still assuming they could earn 5% return, which in today's market is unheard of. There's no bond paying 5% return. It's a government bond. All right. And so what's ended up happening is a lot of these pension funds are actually jumping into equities and investments they traditionally would never be found in. Right. Even central banks are buying stocks at this point. So now you know how the bond works. These are very basic terms. Bonds are super complicated. If you start calculating durations, I would lose 99% of you, and I might be one of the person that gets lost in it. It gets complex. All right, any questions so far? As a summary, you're lending your money, you're receiving an annual return on a percentage basis called the yield, and at the end you get a return of your capital and nothing more. All right, so you're financing something. So what are coupons? Coupon payments are the return to the bondholders and investment. Remember, we're speaking about a government term here. And on the flip side, to the person you're lending the money, in this case, it's the United States government, they're called the debtor or the borrower, right? Think about this. What impact would an increase of interest rates have on you as the investor? Just get the gears turning here. Would you make more money or less if you're looking to purchase a bond and interest rates go up? You'd be making more. Right? A higher interest rate means you receive a higher coupon payment or a bigger yield. But what would happen to the debtor? That being the United States government, the person who is actually in debt to you for your capital. They're going to have to pay you more. Does that make sense? The United States government will have to pay more to service those bonds. So eventually what that means is that higher interest rates are a massive obligation for the United States government because they have a ton of debt, we'll see in a moment. And this is one of the reasons that increasing interest rates, they may hurt your everyday consumer. They may hurt the markets, but the real people that they hurt is the US government. All right, I read somewhere that if interest rates went to 5.5%, all right, think about this, 5.5%. It's not that high compared to traditional standards. It is high compared to today's standards. The United States government's interest payment will exceed the amount of money they have from the bonds. Essentially, they need to raise more bonds just to pay the interest. All right, and that's a problem. So that's number one thing you have to realize is that interest rate sensitivity to bonds, interest rates going up reward savers because they earn more, but they hurt debtors. And the biggest debtor in today's society is government. We'll see that in a moment. All right, so why does the government sell bonds? Well, to finance their budget needs. All right, have you guys ever wondered if you go to the hospital and you receive any kind of care? I mean, in the United States, it's not, it's privatized. It's not government level like it is in Canada. But let's say you go in and you drive on the road and you see that there's construction. You say, damn it, I'm going to be late going home for work. But do you ever think about who pays for that? Who pays for that road? All right, who pays for defense spending? For the military? Who pays for the infrastructure, the healthcare, the social benefits that come along with living in a country? All right, taxpayers, yes, but you're going to find out in a moment, no, not so much. You would think taxpayers, right? It's a very common one, taxpayers. However, really at the end of the day, it's more than that. Have a look at this. Here's the discretionary budget request in 2019 from Donald Trump, 1.19 trillion. The United States has now spent more than $1 trillion this year, and it's 30% higher than the previous fiscal year. So expenses are going up. 61% of the government budget is spent on military every year, $727 billion. All right, does that shock anyone? 61%. Veterans benefits are obviously the second highest because the military expense is so high. And then education, housing, community, health, transportation, all the things we talked about eat up the budget, but the biggest one's military, right? You have to defend the US dollar as a reserve currency worldwide. How do you do it? With military. All right. Who owns the U.S. debt then? Right? Because we said taxpayers finance part of the expenses of a country. So let's put ourselves as the owner of the United States. You are now the owner of the U.S. and you have to pay for all these benefits that people that work for your company, which are citizens, are taking advantage of. How are you going to finance or raise this money? Well, debt owners and bond owners who are paid coupons and provide the financing to the U.S. are as follows. This is how it breaks down. The U.S. government owns $5.73 trillion, or 27% of the total outstanding U.S. debt. So the government owns the government 27%. This is local to federal governments and different government bond denominations and treasuries on the book. All right. So really, when people say, look, there's $21 trillion of debt in the United States, if the government forgives its own debt, it brings it down to around 16. Still a crap ton, but less. All right. So where's the other part come from? The Federal Reserve owns 11% of the bonds, but look at this. U.S. investors finance 32.5% of the United States budget through their bond program. All right. Foreign investors, 29%. So 60% of all bonds are owned by investors. Again, this is institutional clients. When we say U.S. investors, most of the people don't own U.S. treasuries on the retail basis. It's on an institutional level because it takes massive money to participate in these auctions and to get an allocation. And then foreign investors, 6.21 trillion. Let's break down the foreign investor one because that's interesting, right? It's 1/3, approximately a little bit less than 1/3 of the entire ownership of the U.S. debt. And it breaks down like this. Japan now actually owns more debt of the United States than China. China's been selling off U.S. debt at a breakneck pace and buying gold. All right, they've been getting rid of their U.S. treasuries while Japan has been picking up the pace. Japan is now the biggest holder. China is the second biggest. But if you look at the piece of the 29%, roughly 33% is owned by just two countries, right? So isn't it interesting that 1/3 of the U.S. is financed 30% by two countries, all right? So who does the U.S. owe? Japan and China. Japan and China are eventually going to get this money. Now, this is a little bit of an aside from the bond market conversation. Where do you think China has billions of dollars to buy U.S. treasuries? Where do you think China gets billions of U.S. dollars to purchase these U.S. treasuries? Boom, Kenneth, trade surplus, right? China sells products to U.S. consumers. The U.S. consumer then spends that money. That U.S. dollar amount gets put into China, and China then buys U.S. treasuries. So in fact, trade surplus goes in part to finance 1/3 of the U.S. budget, right? So it's a win-win relationship. Now, why doesn't China take those dollars instead and use them in their local currency? Think about this for a second. This is where the trade war problem and tensions begin. And I'm going to do a whole separate webinar for you guys on this. A little bonus on the China and U.S. trade war situation, how it can be resolved, and the real truth about it, because very few people actually understand. There you go, Jeff. Jeff pointed out, if China took the U.S. dollars that they received from sale of goods and converted it to yuan, what would happen? The U.S. dollar would go down slightly. The yuan would increase in value because there's so much demand for it. What happens when the yuan increases? Now their goods are no longer as cheap as they once were, all right? So in fact, by China purchasing U.S. Treasury, it helps the U.S. Finance their own obligations on an annual basis to run the government, and it also helps them keep their yuan weaker. Now, they have done something that makes them a currency manipulator. Since 2005, they haven't. They've reversed course. But this is where a lot of the problems occur. The problem with this trade war is that the two sides need each other. And China was built, they started with currency manipulation, and now are actually helping preserve the yuan. They just got labeled a currency manipulator now, but what's unfair about that is they haven't been currency manipulating since 2005. 05 is when you should have said you guys are massively manipulating your currency, because there were. That's another topic for another day. All right, so now we know who owns the U.S. debt, all right, who the U.S. owes money to, and where coupon payments or interest payments are going to. So if interest rates were to go up 5%, all right, Japan and China would be receiving more US dollars. The US would owe more money to them. And when Donald Trump says, hey, you know what, if interest rates were lower, the economy will be that much higher, it's not because of the stock market, right? It's because the US would owe less money, which means what? They have more to spend on their own domestic operation of their government. Does that make sense? All right. So who else owns US debt? Stephen Box. Mark suggested I throw that in here. I don't know if Boxy's in here. Boxy has a big bond portfolio. He loves his bonds. All right, so it's three people: U.S. investors, foreign investors, and Stephen Box. All right, bond yields and curves. Now, this is where it gets exciting. All right, this is where it gets super exciting. Yield versus price. So let's take a hypothetical example. All right, you buy 10,000 bonds with a face value of $100. So retail bond, you'll almost never find a bond for 1,000 or 100 face value, but let's just use it for numbers' sake. You buy 10,000 bonds with a face value of 100 for each bond that you purchase, totaling your investment of $1 million. All right. The coupon payment is 3%. So what does that mean? How much do you make a year? 3% on $1 million? Anyone good with math? $30,000. Okay. That's your return on an annual basis. So the federal funds rate is also called the risk-free rate. The risk-free rate is the rate at which you could put money in very cash and liquid resources, cash or cash equivalents, and earn a guaranteed rate with very high safety. That's sort of like if you have a lot of cash, you don't know what to do with it, and you put it in a savings account. That's what we call the risk-free rate. Is your bond an attractive investment? Yes or no? It's paying you a 3% coupon, and the federal funds rate's 2%. Are you making more than the risk-free rate? Yes. But suddenly, all of a sudden, Jerome Powell says, you know what, Trump, your 2020 election is out the door. I'm going to hike rates by 10%. Now, let's not get aggressive, by 3%. Powell wouldn't do this, but I just want to explain something to you. Jerome Powell raises the FFR to 3%. First thing that's going to happen is he's going to get a call from Donald Trump immediately. He's going to be pissed. All right, but now let me ask you this question. Would you be willing to pay more or less for the same 3% coupon bond? More or less? Less. And that exactly is why when interest rates increase and when bond yields increase, bond prices drop. Did you understand it now? Because we've always said when bond prices go up, yield rates go down. When bond prices go down, yield rates go up. And now you understand. Because when the interest rate adjusts, it makes your bond either more expensive or less expensive, depending on how attractive it is according to the risk-free rate. All right, so if the 3% matches your risk-free return, maybe nobody would want to pay $100 for this bond. Maybe it's only worth 90. All right, so this is exactly why yield and bond price is inversely correlated. Make sense? So now the risk-free percent is 3%. The risk-free rate is 3%. What do you need to do as a government in order to raise more money? Think about it from an institution's perspective. You could put cash into a bank account and earn 3%. Boom, raise the interest rate. So yeah, you could sell more bonds, but nobody's buying them at 2% anymore. In order to raise capital, now you have to increase it above the risk-free rate, which means what? Now you have to pay more for the same money, so that money is worth less, and the bond price goes down. Right, so you're going to have to pay more interest in order to generate the same amount of money. This is what we mean by saying the cost of borrowing has gotten higher. All right, makes sense so far? Because now you're going to start to understand some cool stuff. So bond yields and bond price have an inverse relationship. Bond prices go up, yields go down. Yields go up, bond prices go down. And in fact, the price is driven by supply and demand, and the yield changes are driven by the Fed. Supply and demand figures out what that yield rate's going to be, but when the Fed moves, the yield moves, hence it either discounts or puts a premium to the price. So those are the two mechanisms. In fact, let me ask you guys a question. Who dictates what the interest rate is, the Federal Reserve or investors? Federal funds rate is the rate at which banks borrow. You know this 2% rate that the Federal Reserve just cut down to, 2 to 2.25%? Who thinks they could borrow at that? Good luck. It ain't going to happen. You can't borrow money at that rate. The rate at which the federal funds rate is set is only for banks. Banks that deposit money into the Federal Reserve System are paid that rate, and when they withdraw it, are charged that rate. Now, what's happening, this goes to negative interest rates. I mean, that's a whole different topic. Let's save that for another time. But the rate that markets and institutions borrow at is the bond yields. Corporations and institutions borrow closer to the bond yield versus the FFR. So when you talk about interest, you're actually talking about bond yields. Did you guys know that? That's more important than the actual federal funds rate. Because before the Fed cut their interest rates, bond yields were already slipping. That cut was already priced in before the Federal Reserve took action. All right, so here's how the yields and the stock markets are impacted. When a stock market rallies, bond yields increase. Why is that? Well, let's look at an example. Opportunity cost increases, right? Because if you want to issue a bond to somebody, if you want to collect somebody's money, you're going to have to pay them more. Why? Because they have the opportunity to put it in the stock market and make 7%. So yes, you're a safer investment, but that doesn't matter because the opportunity is higher elsewhere. So you're going to have to pay more. So if the stock market's yielding more, you're going to have to pay more for your bonds in order to attract capital. Because guess what? When an economy is expanding and the markets are booming, is there fear? There is, but not as much. The fear is very little. And if there's no fear, the bond doesn't have attractiveness to it. Bonds are being sold, yields are going up. And you're going to have to pay more interest in order to command attention and attract capital. You're going to have to compensate people for it. And that's why yield rates go up with the stock market. And that's why when we see a yield curve, it's a normal yield curve. And I'll show you what that means in just one moment. All right, it's a balance of risk to reward. So here's what a normal yield curve looks like in a bullish economic expansion. Bullish market and a bullish economy, because the two things are different. Right now, we're seeing a very bullish market with a neutral economy that's slowing down. As an investor, do you expect to be paid more or less for a longer commitment period? All right. Do you want to be paid the same for a 3-month loan to somebody or a 30-year loan? Which one would you need to be paid more for? For the 30-year, right? Doesn't it make sense? Because there's a longer period that you're tying up your capital, you need to be compensated higher. And the reason for that is because, right, who has that kind of capital to tie up for 30 years? There's 100-year bonds, government bonds too. So to provide that kind of financing for that long, you're going to need a higher rate for two reasons. Number one, your opportunity cost is way larger. And what's number two? Think about this for a second. In 30 years, the money that you receive for your face value is worth less. That's inflation. Does that make sense? The longer you commit your money for, the less it will be. You will get $1,000 back in 30 years, but that might only buy you a pack of bubble gum. If you're in Zimbabwe, even less. Right? So you're going to be able to buy less with it in 30 years. So you're losing purchasing power. Therefore, you need to be compensated greater. All right. So look at this. Yield percentage on the left scale. Gabriel, I answered that question in a moment. It's a very good one. All right. So what you're seeing here, hey, how come it's not working? I think I lost my keyboard. I don't need a keyboard. All right. For 3 months, let's say a 3-month bond, you're only willing to take X amount of yield. What is it? Doesn't really matter at this point. Just do it just 3 months. For 6 months, you want to be paid a little bit more. All right. For 1 year, you expect to be paid a little bit more. For 5, more than the 1 year, and exponentially more than the 3. For 10, even more, and 30 years the most. All right. And if you draw a line to literally connect these points, what you have is what we call the yield curve. And when we remove these bars below, this is what a normal yield curve should look like. The longer that you tie up your money, the more you expect it to yield. So really, one other way to say a yield curve, it is the compensation for opportunity cost of your capital. Make sense? All right, let's roll with this. Here's what happens in a traditional bull market. This is from 04 up to the collapse. You could see stocks are going up. The S&P 500 is a candle chart. The lighter shade is a 5-year yield. The darker shade is a 10-year yield. And the really dark shade is a 30-year yield. And as you can see, for the most part, they're all moving up as the stock market moves up as well, especially the shorter term yields, because they're closer. They're like a moving average. They move closer with the market. All right. Now let's talk about the yield and the economic contraction, because this is where I think we are at the moment in the cycle of the economy and the market as a whole. This might take you a few times to go through to get it, It's a concept that's a little mind-bending. All right, what happens when the economy contracts? All right, opportunity cost decreases. Think about an economic contraction. What does that mean? It starts with corporation profitability. Companies are making less sales. What does less sales mean? Less profit, right? Less sales isn't dangerous because you can cost cut up to a certain point. So there's a leg to this. Less sales can get absorbed, which is called a soft landing. But if sales are less for longer, cost cutting is not going to do it. Now you're going to start to lose money. You're going to make less profit. Less profit means less return to the shareholder, less salary. Less salary means less income for employees, which means less spending. 80% of GDP in the United States consumption. Less spending equates to what? Less sales for these companies. Now that cycle repeats. Less sales, less income, less salary, even less sales, and it continues to contract downwards. That's why these recessions happen fast, quick, and they hurt a lot of people. And not only that, but less savings, because there isn't anything left over after you're paying for your essentials. So your opportunity cost is decreasing, because if the economy is going down, what is really your opportunity cost? Right? It's not that much. Where are you going to put your money? Everything's going down. This is why assets like Bitcoin are very interesting, because Bitcoin is very uncorrelated to any other market. It's untraditional, and this is why institutions are starting to like it, saying, hey, this thing's not correlated to anything. Great. If the economy dumps, I don't know that it's not going to fall, but I know for a fact stocks will, right? So opportunity cost decreases. Now what is capital doing? It's looking for safety, right? So now as an investor, when the economy is contracting, you're not looking for greed. Now you're starting to act on behalf of fear. Samuel said it. Fear is 3 times stronger emotion than greed. All right. Fear is a very root animalistic type of quality that shuts off your logic factor and triggers your animal brain, the reptilian brain in the back of your mind. That's survival mode. All right. Cortisol, stress, all the good stuff that come with it. So now that there's perceived fear out there and the economy is contracting, you're willing to earn less. And the less that you earn on your investment is compensated by the fact that it's more safe. Are you with me? You're willing to earn less because your capital is safe. There's carnage around you. All you want to do is preserve your money, right? So what ends up happening? You start to buy bonds because bonds are traditionally safer. You're saying, hey, remember when you were willing to sell me that bond for 3%? And I said, no way in hell, I'm long in equities. Would you mind doing it at 3%? Guess what, though? Now it's not only you. There's 100 people lined up at the door. Now the balance of power is shifted to the bond market. There's 100 people at the door. You're like, 3%, good luck. I'll give you 1.25. And you think about it, and a guy behind you comes up and says, I'll take it. Now you're saying, oh, crap, now 1.25 seemed good. You say, I'll take the bond. You're like, nah, now it's 1%. So what's happening is, because money is afraid, it goes to bonds because bonds are safe investments. They're not going to pay you a whole lot, but you're going to get your money back, which means what happens? The yield rates drop, because in order to raise money, you could pay people less interest because you're giving them safety. All right? Anyone have a wow moment there? And what that equates to is capital is fearful, investors sell the short-term bonds and they move into longer-term bonds for safety. All right? And it inverts the curve. Why does that happen? Think about this. If you have a 3-month bond at the moment, all right, and the economy is dropping like a bucket, why would you buy a 5-year bond? Because you're like, look, in 3 months' time, maybe I won't be able to get 3%. Maybe I'll be only able to get 1%. I should lock it in now. Does that make sense? So you're dumping these 3-month bonds like it's a wildfire. You're saying, I want safety for longer. The more pain you feel, the more you value safety. So you say, I want longer safety. 3 months is enough. I'm selling that bond, and I'm going to go into a 5-year bond, because by then the recession is going to be over. Right? So overall, whenever there's an economic contraction or recessionary pressure, bond yields across the whole curve will go down. However, what ends up happening is the yield curve inverts. Let me show you something. When the yield is higher for shorter term periods than it is for longer term periods, it means liquidity is compensated, and this is what ends up happening. 3-month yield is higher because bond prices are going down. And think about what the government needs. Everybody wants a 5-year bond and that's where they're trying to put their money. But the government says, hey, we're going to come out of this in 5 years. We don't want to be locked in at this low interest rate. And they value liquidity, but the market isn't willing to give it to them. Yields go up on the front end of the curve, and they start to contract towards the bottom end of the curve. And what you get is a yield curve inversion. It's very, very rare to see a full-on yield curve inversion, because that means you're getting more money, more yield right now than you are in 30 years. But it's very often you get a partial yield inversion. A full yield curve inversion doesn't happen very often at all for extended periods of time. However, the difference between the short term to the middle end of the curve is the most important, because that's usually what a recession lasts, between 2 to 3 years. And this is how you get an inverted yield curve. So normal yield curve is like this, inverted is negative slope. All right, so that asks the question, where are we right now? At the moment, the yield curve in the United States has inverted. The one that most often is followed is the 2 and the 10-year. The difference between the 10-year yield and the 2-year yield is what traditionally investors refer to as the yield curve. Okay, because it's the middle rate bonds, it's still active paper, and it's a very short-term cash equivalent paper. The 30-year, most institutions that plunk it into the 30-year could survive a recession. You know what I mean? It's not as, hey, we're going for a recession. Great, I locked in a 30-year at 5%. Bring on the recession. I might even sell this bond and buy some assets when it bottoms out. I'm in good position. I'm getting paid to wait. So as you look at this yield curve at the moment, from January 2nd, it looked like this. There was a temporary blip between the 1 and 2 year because Federal Reserve expectations were for rate cuts. And now it's a full-on inversion from the 2 year up to the 2 year and flat to the 7 year as of August 14th. The yield curve's inverted across the entire term structure of bonds. Now, when we look at just oh, by the way, just what I want to show you is the yields go down as the market goes down. I'm going to show you something in a minute. Stocks versus bonds and yields. Here's a little graph for you to remember. In an economic expansion, stocks will be going up as bonds are going down, and yields are increasing. And in an economic contraction, stocks go down while bonds go up and yields decrease. All right. Now let's talk about this yield curve and recession signals. I got some pretty interesting stuff for you here. I'll open up for some questions as well. So have you heard of the term inverted yield curve before today? You probably have. It's all over the news. And what do you hear? Oh my goodness, there's going to be a recession, right? The yield curve's inverted, a recession's coming. So when the 10 and the 2 year bond yields invert, it has predicted major recessions in the past with 12 to 16 month accuracy. Let me give you some numbers. Here's some examples. When the yield curve inverted in 2007, about 9 months later, we had the 2008 housing bubble collapse, 2007, 2008. All right, before the tech bubble crash, the 2 and 10 year yield curve inverted. And before the crash of the early 90s, the yield curve inverted. And there's been a yield curve inversion in every recession. However, not every yield curve inversion has led to a recession. That's an important differentiation. Correlation is not causation. Let me show you some examples though. So let's go back to 1966. I wasn't even born yet. But in 1968, there was a yield curve that inverted, right? But no recession occurred. Later on in 1968, 2 years later, 24 months, the yield curve inverted again, and the recession came in the early 70s. All right. And then the yield curve inverted March 9th of 1973. And 7 months later, in 1974, a recession happened. And then the yield curve inverted in August 18th of 1978. And then 16 months later, the recession happened. All right. And then the yield curve inverted in 1988. 18 months later, the recession came. February 2nd of 2000, the yield curve inverted. And then 12 months later, the recession came. June 8th of 2006, the yield curve inverted. 17 months later, the recession came. So yes, it doesn't always happen, but 1, 2, 3, 4, 5, 6, 7 times it happens, 2 times it doesn't. So the stats are 7 of the last 7 recessions had a yield curve inversion, and 9 of the last 12. There have been yield curve inversions that didn't lead to a recession. However, those were ones that didn't stay for a long period of time. They just inverted and bounced right back up, which is the case as of right now. We haven't had a long extended period of yield curve inversion. It's a temporary act. But what you need to know is the average time is about 14 months from yield curve inversion to recession. Now, here's the crazy part. What is the average gain between an inverted yield curve to the recession time? 30%, right? There's 30% of additional upside to equity markets after a yield curve signal has happened and before a recession. So when you look at the media and this fear mongering, say yield curve inversion, oh my God, recession, that might be true. I happen to believe that it is true. I happen to believe that, around election time for Donald Trump, until the election, I happen to believe that they're going to do everything possible to sustain the stock market, not the economy, the stock market, to get us to a point where we don't have a recession. But I think if what continues happening in the economy happens and evolves, there's a very, very high likelihood, around a 60% chance, I was looking from Goldman Sachs, for a recession occurring within the next 12 to 16 months. One of the biggest risks here is the trade war with China and the US. Another big risk is every central bank across the world is cutting rates like there's no tomorrow, and it's not doing a damn thing. All right, markets are being sustained, but from an economic standpoint, you're starting to see some things start to crack. Let's talk about this. There's more to a recession than just bond yields. Bond yields is just an indicator. If your gas light comes on in your car, do you smash the brakes on the highway? Do you start thinking about going to the gas station? Yeah, perfect. It's starting to go. Bonds are signaling a recession within 12 to 8 months statistically. But it's not a signal to start shorting everything and cashing out. Not a time to run for safety. There's more to a recession. In fact, here's a few things that the recession looks at. Real GDP, that's national output and income falling. Unemployment numbers start to rise. Inflation tends to fall. What's the danger to inflation? Think about this. Why is falling inflation a bad thing? Because falling inflation means cheaper prices for you and I. Disinflation, which is dropping inflation. Deflation is when inflation is negative. But before it gets to deflation, there's disinflation. Why are cheaper things for you and I bad? Well, because it's less profitability, and that company may not give us a job to have income to buy these cheaper things. And decreasing or disinflation makes debt more expensive. Who do we say just has a crap ton of debt? You guys get this. It's going to blow your mind. We're coming full circle here. The US, the government. It's not just the US, a lot of governments worldwide. But the US has a ton of debt. Dropping inflation makes debt more expensive. And the more expensive debt becomes, the more likelihood of a default because there's already a really high level of debt. So governments, that's why the Federal Reserve exists. You think it's a coincidence that their whole mandate is to keep inflation at 2%? So they could devalue the worth of that debt. So in 10 years, when the bonds come due, they have to pay back less purchasing power. This entire economic expansion is fueled by debt, but predicates on one thing. We have to have one thing for this global economy to work. What is the word? You need to have growth. The second that growth destabilizes, right, it becomes unsustainable. That's all it takes. A peaking or declining rate of growth puts a lot of pressure on the economy, all right? And debt is not sustainable if there's no growth. If there's no growth, there's no inflation. If there's no inflation, there's disinflation, makes the government debt cheaper, makes interest rates higher, makes money today worth less than it will be tomorrow. That means if you borrow somebody's money today, you got to return it at the disinflation rate. You got to return more than you borrowed, plus the interest on top of that. And as the money becomes more expensive, you're paying more interest, same interest, but it feels like more based on lower purchasing power. Now corporations have less profits. Mass layoffs happen, and it just perpetuates and it creates an unsustainable default scenario. 100% of the roads lead to the same thing. You need growth. Since the Federal Reserve, since 2008, a lot of people don't understand, the economy just isn't the same. It's running on huge debt levels, and all it's doing is being financed by growth. The second the growth stops, we're in big trouble. Asset prices, another consideration of an inflation, interest rates, investment, and there's a lot of things that go into it. So many that I wanted to show you the current economic conditions. This report is available for you in the Elite page. If you go under the archive We're wrapping up here shortly. If you go under your dashboard and then go into the elite coaching calls, or the monthly coaching calls they're called. Darn it, just clicked the wrong link again. Monthly coaching calls, and go under today's. All right, they're already here. I put together some resources for you. I sourced them. I curated them. I didn't create these. It's National Economic Indicators as of August 2019 from the Federal Reserve Bank of Richmond. And it's a huge report. I just opened it. All right, it's 30 pages long, more, 63 pages long. And what I'm here to tell you is it's not a terrible scenario. GDP growth is still positive. It's declining. The growth rate is decelerating, but it's not negative by any stretch of the imagination. We're just growing at a less rapid pace. That's okay temporarily, but things get a lot more dire when growth turns negative. Not only dire, unsustainable under the current global economy. We need growth, all right? GDP growth is dropping. Retail sales are starting to drop, still positive, all right? Consumer spending and income starting to drop in 2019, all through 2017. Sales of automobile vehicles have started to drop. Personal saving rate is going up. That's actually a recessionary sign. People are more worried. They're saving more money. If you weren't worried, you'd be out there buying Gucci sandals, right? Household net worth starting to drop. Existing sales, existing single-family home sales aren't increasing. They're not dropping. New single-family home sales peaked as well temporarily in this cycle. Real investment in non-residential structures is now negative. Real investment in equipment, slightly higher. Intellectual property investment is dropping. Balance of international trade is dropping. Industrial production is seeing a little bit of, it's done pretty well, mining, but manufacturing has peaked in 2019. It hasn't exceeded its 2018 level. Capacity utilization rate in manufacturing is dropping, right? There isn't one economic indicator you could see here that isn't dropping in 2019. Yet the stock market's doing just fine. I'm telling you guys, the economy and the stock market are not one and the same. So when you look at a recession, it's not time to freak out, but things are slowing down. So what does this mean for you? First of all, what is a recession? If any of you guys want to read that full report, I've put it into the presentation notes so you could download it. It's not going anywhere. I put it on our website. So even the Richmond Fed takes it down, you still have it. All right, go ahead and have a look at the picture. You deserve to know. A recession's defined as 2 consecutive quarters of negative GDP. But by the time that happens, it's too late. National Bureau of Economic and Research, NBER, will say, oh, we're in recession. And you're going to say, yeah, pardon the language. I only use it to paint a picture. Be like, yeah, no shit. My portfolio is down 20%. Thanks for telling me we're in a recession. By the time you know it's a recession, it's too late. Right? How do you time a recession? You don't. That's why it's called a recession, and drops are so sharp. You can't time it. You can, however, start to look at the information and do some actions or take some action. And here's what you could do. This is how you apply all this information to your trading investing. Number 1, day trading. The good news for you. Bonds are inversely correlated to stocks. Therefore, use these correlations for your trade qualifiers. Now you know why bonds and stock markets move in direct opposition, because when bonds are in favor, stocks are being sold. There's actually a good piece about portfolio management in the futures course you want to review for that. Use the correlations for yourself, and know this: if we do have a recession, you're going to have increased volatility and you're going to make a ton of money. If we have a recession in the next 12 to 16 months, I'm looking to make 5 to 6 times my annual income during that period, right? No joke. And you will too if you're in the day trading. Not guaranteed. However, step on it, make the money, but all I ask is you be humble, because you and I, day trading, are not the everyday person. And that's who's going to take it the worst. All right? Take advantage of it as a day trader. It's your job. You've waited, you've worked hard, you've earned the right to trade this. Short the crap out of everything when the time comes. Just be humble about it. All right? Take off the Rolex, park the S63 AMG, take the bicycle to your parties, because a lot of people are getting hurt. You can't be celebrating that. In recessions, I make good money, but it never feels great. Donate some of it. All right? There's a lot of traders who in 2000, September 11th, after that, donated a lot of their profits in recovery funds and for the families of firefighters, ambulance workers, and emergency responders. All right? That's the right thing to do. All right? Passive investor, consider adding less money to the long side in the stock market. If you have a massive long portfolio, this isn't the time to liquidate everything, but at least cut down the pace that you're adding into the long side. That's what institutional investors are doing. In fact, the institutional investor now is even taking profit on the rallies. The times have changed. The party's starting to get close to the end. All right, so that's what the option. You have a passive investor, and watch these key economic indicators closely, much closer than ever before. In the middle of a bull market, having one economic indicator miss, no big deal. You laugh about it over beer and you keep buying stocks. When a lot of them start missing and at the same time, and the markets are going up, there's a disconnect. You have two choices: to be ignorant of that and keep buying stock, or to start giving some weight and importance to these missed economic indicators and starting to take action. Right? I'll tell you one thing. Before a recession, I've traded through two of them personally. My trading career spans 2 recessions. Before any recession comes, it always feels weird to be selling. You're going to be selling, say, I'm taking profit, and it might even go up a little bit more and say, damn it, why did I sell? Your friends are saying, oh my God, you're crazy. I just bought Beyond Meat, made like $20,000 in 6 days. You're saying, should have I got out of that position? Preparing for a recession never feels right. That's a recession for you. All right, you're not going to get the timing right. There's a little bit of a slippage there. But there's no harm in getting paid for your positions. Remember, you may not be getting paid more, but you're not exposing yourself to the risk. It's the same idea behind all this money chasing safety. They buy bonds for less return, but damn it, that money's safe. It's the same idea for you as a professional trader. All right, watch these key economic indicators, and as they start to deteriorate, don't hesitate to start taking profit on your portfolio. All right, follow up on trade war news. This is single-handedly the one thing that has, I think that the media makes this thing out to be something cute. Like, oh, trade war, who's going to win this or that? I'll tell you who's going to win the trade war. No one. Both people are going to lose, and it's going to suck. And it's kind of convenient for the media to sort of brush it off aside or give these latest updates. But this thing's really dangerous. And that's why the market reacts so much. You know, we laugh at tweets. Donald Trump says that maybe they're going to talk with China. We laugh like, how many times are you going to say that? But it's important. It's really darn important for the future and the stability of the economy. That's why it makes such a difference to the market, right? So keep tabs on that. It's very important. Victorio's publishing a really good page on our website that updates the whole timeline of the trade war. So for all trade negotiation, trade war things between China and the U.S., and be prepared to start liquidating your stocks and start buying bonds and gold. That's the assets that do well. Bonds, gold, and utilities. As I tell you that today, I've actually got 3 orders in to buy those 3 things at a limit below. Not because I think a recession's coming right now, but I want to start opening a small position for safety. Whenever things are about to turn, it always feels like it's the less likely to turn. When you're saying there's no way a recession's coming, that's when it's coming. All right, so those are the things you can do. As an active trader, take advantage, make active income. As a passive investor, look to start taking some shelter. Institutions are doing it right now as we speak. All right, when a recession happens, there's very little time to act. By the time that you know it's time to start taking action, it's too late. Because guess who else is coming into that same idea? Everyone else. You don't want to be getting in with everyone else. The lost opportunity of another 6 to 7% in the stock market, to me, is a way bigger risk than cashing some out and staying in cash. All right? Safety is often underrated in a bull market and way overrated in the bear market. All right? So that's the presentation for you guys. Now you understand bonds, bond yields, yield curves, yield curve inversions. Yield curve is a recessionary signal. Is there a recession coming? And I want you guys to take a moment and look at the supporting documentation of this webinar and go through at the bottom and read these economic indicators and make a decision for yourself on what the right course of action is for you.
All right, trade pros, I hope you enjoyed this video, and now you know what bond yields are and what it means for the economy. If you want to be part of our next elite coaching call, click the link in the description and get started. Please subscribe to our channel by clicking here, and be sure to hit the notifications bell so you're alerted when we have new content. To get our free training course, click here and get started right now. That's all the time we have for today. Manage your risk and trade like a trade pro. Thank you for tuning in and have an awesome rest of your day. Goodbye.